Do you have a business? Then right now you need to keep an eye on interest rates rather than the Bank of Canada policy rate. Why? Well, because interest rates have more influence on your financing costs, margins, and investment decisions. Here's the latest news. The Bank of Canada maintained its key rate at 2.75% at its June 4th announcement, but this rate has fallen by 225 basis points over the past year. Good news? Yes, but not for everyone. If you have a variable rate loan, you've probably taken advantage of this drop. But if you're looking for a fixed rate loan, that's a different matter. The 5 and 10-year rates have risen recently. What does this mean? Well, the prime rate, the rate that influences variable loans, is set to fall a little further this year. But for fixed rates, it's more complicated because they depend on the bond market and therefore more influenced by what's happening south of the border. Here's why. The US economy remains solid, so markets are expecting fewer rate cuts. Inflation is slowing, but remains too high for the Fed to ease pressure significantly in the short term. To finance public deficits, the US government has to borrow more, driving up interest rates. We also have the risk premium requested by investors, which has risen significantly due to trade tensions, adding upward pressure to interest rates. What does it mean for Canada? Effective rates have fallen, but not as fast as the policy rate. And even if the Bank of Canada lowers its key rate, interest rates could remain high for some time. For entrepreneurs, this means that central bank decisions have less impact on the economy in the current context.